Hello everyone, welcome to EduTap and welcome to the Finance 360-degree session. So in today's session, we are going to discuss one of the most important reports of the Reserve Bank of India, that is the Financial Stability Report that is released on 30th June 2025. So this is recently released, okay? So this is a very important report that we are going to discuss in today's session. The important data points we have to focus on, and this report is important from the objective point of view, from the phase 1 and phase 2 perspective, as well as this report is very important from the descriptive point of view also, okay? So we are going to have the detailed coverage of this financial stability report that is recently released by the Reserve Bank of India, and the most important data points I am going to discuss with you in today's session. And there are 3 chapters in this report, so we will be discussing all the 3 chapters in this one session so that you get the relevant material in a single session and you do not have to go here and there to search for the important material, okay? So this is a very important report of the Reserve Bank of India. So let's get started with today's session. But first of all, give me a thumbs up if I'm clearly audible and visible and everything is fine, okay? If the screen is clearly visible, give me a thumbs up, okay? Okay. So let's get started, but before that, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session. And the PDF of this session is very important because here you are getting the relevant material, okay? And the link for the Telegram channel is provided in the description box below. So let's get started without any delay. So the Reserve Bank of India has released the Financial Stability Report for the June 2025, okay? So the RBI has released the Financial Stability Report for the June 2025 and this is recently released. Now the Reserve Bank of India has released this June 2025 issue of the Financial Stability Report, which reflects the collective assessment of the subcommittee of the Financial Stability and Development Council. So first of all, there is a Financial Stability and Development Council that was constituted through the Government of India notification dated 30th December 2010. So the Financial Stability and Development Council, this was constituted on 30th December 2010 in 2010. Now the FSDC, this council is headed by the Union Finance Minister. So Finance Minister is the head of this Financial Stability and Development Council. Now under this Financial Stability and Development Council, there is a subcommittee. That is the subcommittee of the FSDC, and the subcommittee of FSDC is headed by the Governor of the Reserve Bank of India. Okay, so I hope this is clear that the FSDC, this is the Financial Stability and Development Council that has a subcommittee, and the subcommittee is headed by the Governor of the Reserve Bank of India. And the Reserve Bank of India has released this June 2025 issue of the Financial Stability Report. Now this issue reflects the collective assessment of the subcommittee of the Financial Stability and Development Council. Now the FSDC consist of the members, that is the Chief Economic Advisor, the Chairman of the SEBI, the Chairman of the PFRDA, the Chairman of the IFRDA. So you can understand that the Financial Stability and Development Council consists of the important members, and the members of the FSDC are also the members of the subcommittee of the FSDC. Now this subcommittee of the FSDC, it contributes for the Financial Stability Report, okay? So Financial Stability Report, this is the half-yearly publication. It reflects the collective assessment of the subcommittee of the FSDC with inputs from all the financial sector regulators, from inputs from the Reserve Bank of India, inputs from the SEBI, inputs from the PFRDA, as well as from the IRDI. Okay, so you can understand that the subcommittee of the Financial Stability and Development Council consists of the chairman of the SEBI, consists of the chairman of PFRDA, chairman of the IRDI, and the subcommittee is headed by the Governor of the Reserve Bank of India. So this subcommittee and the subcommittee provides the assessment for the Financial Stability Report, and the assessment has come from all these entities, all these important entities. So the Financial Stability Report is a very important report that reflects the collective assessment of the subcommittee of the Financial Stability and Development Council, and the inputs is taken from all the financial sector regulators. Now this Financial Stability Report shows the assessment and evaluation of the subcommittee of the FSDC on risk to financial stability and the resilience of the financial system. So whatever risks are coming to the financial stability and whatever resilience is there in the financial system, so that is shown in this Financial Stability Report. So Financial Stability Report, it shows the risk for the financial system and the resilience of the financial system that we are going to discuss in the coming slides. Okay. Now, FSR consists of 3 chapters and a systemic risk survey. So the FSR consists of these 3 chapters. The first chapter is about macro financial risk. Macro means regarding the whole of the economic system. Okay. So the chapter 1 discusses the macro financial risk. Chapter 2 discusses the financial institution soundness and resilience. The chapter 3 discusses about the regulatory initiatives in the financial sector. And with these 3 chapters, there is a systemic risk survey that is also released. So all of this we are going to discuss in today's session. Okay, these 3 chapters and the systemic risk survey. So let's start with the first chapter, that is regarding the global economy and the domestic economy. Okay, so first chapter is about the macro financial risk. So we have to discuss the risk of in the global economy and the domestic economy. Okay, so global economy, first of all, the global macroeconomic outlook has deteriorated because of the persistent trade frictions that are arising between the developed countries, that are arising between the different countries. So you know that the US is adopting the trade policy that is very inconsistent as well as that is very problematic for many of the other countries. Okay, due to which the trade war condition also initiated. Okay, so because of the US trade policies as well as there is uncertainty around the economic policy of the US also, due to which there were many uncertainties that arose in the global economy. So global macroeconomic outlook has deteriorated because of the persistent trade frictions between the developed countries and the persistent trade frictions that are arising between the different countries, heightened policy uncertainty, and especially there is a lack of clarity around the economic policy of the US. So there is a lot of uncertainty in regards to the economic policy that the US is going to adopt and the US is adopting. Okay, so there is uncertainty at the global level and weak consumer demand. Despite some easing in the tariff tension due to the prospect of trade deals between the different countries, the economic outlook remained fragile amidst the elevated trade uncertainty between the countries and the uncertainty around the economic policies of the different countries also. And this fresh issues of the trade problem and the trade uncertainty and the economic policy uncertainty, now these fresh problems are interacting with the existing vulnerabilities. The existing problems are the increased public debt levels. Okay, so at the global level, many of the countries are having huge public debt levels, and the countries, they are having high public debt levels, due to which it is becoming a problem. There is excessive risk taking in the non-banking financial sector, and there is elevated asset valuations have the potential to amplify the fresh shocks. So the fresh shocks are the trade uncertainty, the trade friction, and the economic uncertainty that is present. So these are the fresh issues. Now they are getting interacted with the existing vulnerabilities of the high public debt level, the excessive risk taking by the non-banking financial sector, and the elevated or the overvalued assets. So in many of the countries, the assets are getting overvalued. So these have the potential, these existing vulnerabilities have the potential to amplify the fresh shocks, the new shocks of the trade uncertainty and such. Okay, so this is the idea. Now this is a data point that you need to keep in mind, because this was not only in the financial stability report, but this was also discussed in the newspapers also. Okay, so the estimate of effective tariff rate on US merchandise import. So the US is doing the import, and on the import that US is doing, on the goods import, that US is doing, US is imposing a huge tariff. Okay, so the effective tariff rate on the US goods import have reached their highest level since 1938, and as per the OECD's economic outlook report that was released in June 2025, that is recently only, the new tariff, as per the OECD, the new tariffs introduced by the United States this year up to mid-May 2025 are estimated to have raised the effective tariff rate on US goods imports to 15.4% from just over 2% in 2024. So you can understand that the tariff rate, they were around 2% in 2024, which have effectively increased to 15.4%. So you can understand that there is a huge increase that is expected, that is estimated in the tariff rate imposed by the US. And that is very problematic, because suddenly if you are imposing so much of the tariff, the trade will be halted, or there will be supply chain disruptions that will come. The supply chain will be disrupted. Different countries will have trade frictions. Okay, so you can understand that as per the OECD, as per the estimation given by the OECD, in this year, that is in 2025 till mid-May 2025, the effective tariff rate has estimated to be increased to 15.4% in 2025 till now. That was just over 2% in 2024. So there is a huge increase in effective tariff rate that has come. Now, citing the escalation in the trade tensions and elevated policy uncertainty. So these are the fresh issues, the trade tensions and the policy uncertainty. The IMF, the International Monetary Fund, in its April 2025 World Economic Outlook has revised the global growth projection downwards. So here you can see that for 2024, the growth was projected at 3.3%, and for 2025, the projection has been decreased to 2.8%. So global growth is expected to further decrease. So you can understand that there is further decrease in global growth that is going to come in 2025, and then it will increase to 3% in 2026, but it is still very low. Okay, and if you see the average of the growth, the global growth averaged around 3.7% in the period of 2000 to 2019. So 2.8%, the 3%, they are very less percentages. They are way lower than the global growth average of 3.7% that we were able to achieve during the 2000 to 2019 period. So global real GDP growth, the global growth historical average during the period of 2000 to 2019 was 3.7%, while if we see the growth rate in the 2025 and the growth rate into the 2026 that is projected by the IMF, they are way lower than the growth rate that was the historical average. Okay, now coming to the global inflation. So if you see the global inflation currently during the period of 2024 and 2025, so the inflation is higher than the average inflation, historical average. So the historical average of the inflation was 3.8%. So the global inflation historical average during the period of 2000 to 2019 is 3.8%. So you can understand that as compared to the historical average, the inflation currently is quite high at the global level. Okay, so the real GDP growth is lower as compared to the historical average, and the inflation is higher as compared to the historical average. So this is showing a problematic trend. The growth is low and the inflation is high. Now coming to the next data points, that the OECD in its economic outlook released in June 2025 has revised the global GDP growth forecast. So as you know that the IMF gives the projection for the global growth, the World Bank gives the projection for the global growth, and the OECD also gives the global growth projection. So as per the OECD in its economic outlook released in June 2025 has revised the global GDP growth forecast for 2025 to 2.9%. Okay, so as per the OECD, the GDP growth is going to be 2.9% in 2025. The World Bank in its June 2025 global economic prospects projected the global GDP growth to decelerate, to decrease from 3.3% in 2024 to 2.9% in 2025. So all the entities, the IMF has decreased the global growth forecast. So all the important entities, all the international entities have decreased their global growth forecast for the 2025. So as per the IMF, the global growth is going to be 2.8% in 2025. As per OECD, it is going to be 2.9% in 2025. And as per World Bank, the global growth is going to be 2.9% in 2025. Moreover, the persistence of elevated trade frictions that is arising between the countries is expected to lower the trade volumes going forward. So that means the trade is also going to decrease at the global level. The global growth is expected to decrease, as well as the trade volumes are also expected to decrease because of the trade frictions between the countries. With the deceleration disproportionately concentrated in around US and China. So the decrease that is going to come in the trade volumes, that will be focused more on US, China and its regional trade partners and the countries that are very much dependent on US and China for their trade volumes. Okay, so this is the idea. Now coming to disinflation. So as you know that at the global level, the disinflation is going on. What is this disinflation? Disinflation is the decrease in the inflation rate. So inflation rate is positive. Let's say it is 6%, that is decreasing to 5.9%, that is decreasing to 5.7%, that is decreasing to 5.6%. to 4.8%. Okay, so this is the inflation rate is positive, but the inflation rate is decreasing. So that is disinflation. So disinflation is happening at the global level. The inflation rate is decreasing, but the momentum of the disinflation has stalled. That means the disinflation is happening, but at a lesser rate, especially in the advanced economies where the inflation generally remains above the central bank target. So in India, the good thing is that you will see the data point of the domestic economy also, that in our country we are able to achieve the target, okay, the inflation target. So in India, the inflation target is 4% plus minus 2%, and the inflation is expected to be around 4%. So in our country, we are at a good position. But at the global level, if you see, the disinflation momentum has stalled, and especially for the advanced economies where inflation generally remains above the central bank targets. Okay, but seeing the disinflation that is happening and the inflation rate is decreasing at the global level, so the countries have, like, seeing the progress in the disinflation so far, the countries have enabled the monetary policy easing. Okay, so the central banks, they have allowed the easing in their monetary policy. They have allowed the monetary policy to be eased, so the interest rate to be decreased. So the progress has happened in the disinflation till now, and on the basis of the disinflation that has happened till now, the central banks have decided to ease their monetary policy in most of the jurisdictions, but except US. In US, it remains an important exception as it has held its policy rate constant in the 2025, and where many of the countries were decreasing their interest rate, were decreasing their policy rates, US has not decreased its policy rate. Okay, so this is the idea. Now coming to the next point regarding the rising debt problem. So we have discussed that the public debt is rising rapidly. So this is a problem, okay, at the global level. So the rising global public debt has been a recurring issue highlighted in the financial stability report. So all the previous 3-4 financial stability reports that were released by the Reserve Bank of India, in all of these, the issue has been discussed about the higher global public debt. Okay, so global public debt as a percentage of GDP is projected to reach above 95% in 2025. This year, it is expected that the global public debt will increase and it will reach above 95%, and by the end of the decade, that is by 2030, it is expected that the global public debt will reach to 100% of GDP. So that is very problematic. So according to IMF, according to the International Monetary Fund, the global public debt as a percentage of GDP is projected to reach above 95% this year in 2025 and above 100% by the end of the decade. And if there is any adverse scenario that comes and the trade policies or the trade friction increases, the policy uncertainty increases, in this case, in the case of adverse scenario, the public debt as a percentage of GDP can increase to 117% by 2027 in the adverse scenario case. So this is very problematic if the public debt is increasing very rapidly, because it is becoming more than even the GDP, okay, at the global level. So public debt as a percentage of GDP is expected to rise by 100% by 2030. So this is the idea. Okay, now the interest rate. Now another problem is that the interest rate growth rate differential is becoming increasingly adverse. Okay, so the interest rate growth rate differential is becoming increasingly adverse as the interest rate is continuously increasing, or the interest rate is becoming very high as compared to the growth rate in many of the countries. For debt sustainability, this is very bad. If the interest rate growth rate differential is decreasing, so that is very bad for the debt sustainability in both the US and Europe especially. This is the prominent problem that the countries are facing. The rating agency Moody's decision to downgrade the sovereign, you can understand that the sovereign, the government rating of the US payments, the government rating of the US has decreased. So the rating agency Moody's decision has been taken to downgrade the sovereign, the government rating of the US bonds, citing the sharp increase in the debt that is taken by the US government. So you can understand that the government bonds of the US have downgraded in rating from the Moody's side. Okay, widening the fiscal deficit. So in US there is a fiscal deficit that is increasing. Fiscal deficit is the total expenditure that is higher than the total receipts of the government excluding borrowing. So fiscal deficit is total expenditure minus total receipts excluding borrowing. Okay, so the fiscal deficit shows that the total expenditure of the government is higher than the total receipts of the government, excluding the borrowing. So there is widening fiscal deficit in the US, and rising interest payments reflect this growing risk. So Moody has downgraded the sovereign bonds or the sovereign rating of the US, citing that there is sharp increase in debt by US, there is widening fiscal deficit in US, as well as there is increasing interest payments. This reflect the growing risk in the US. So that's why the sovereign debt or the sovereign rating in the US has been decreased by the Moody's. Now coming to the next point, now we are going to start with the domestic economy. Okay, till now any problem anyone has? Till now any confusion? Any problem? So starting with the domestic economy, so first of all, the Indian economy supported by strong macroeconomic fundamentals remained the fastest growing major economy in the world during 2024-25. Moreover, as India's growth is largely dependent on the domestic demand because we have huge population, so that's why our domestic demand boost the production. If the domestic demand is higher, that boosts the production in the country and that helps in the growth in the country. If the production is increasing, the growth will increase in the country. So basically, the India's growth is dependent upon the domestic demand, and that's why the external shocks are limited, like they are creating limited effect on India. Okay, so the impact of external shock remains limited. Now, the Reserve Bank of India has projected the real GDP growth at 6.5% in 2025-26, same as 2024-25. So you can understand that as compared to the global growth, the India's growth is going to be way higher. So RBI has projected that the real GDP growth is going to be 6.5%, is projected at 6.5% for 2025-26, same as 2024-25. Now this was discussed in the Monetary Policy Committee meeting that happened in June. Okay, and the reasons were given that why we are expecting the real GDP growth to be around 6.5%. So it was said that the rural demand is increasing, the capital expenditure is increasing in the country, and the business are also like they have also positive expectations. So there were various reasons that were given. Now, as you know that the Monetary Policy Committee next meeting is soon going to be held. So in the coming Monetary Policy Committee meeting, whatever the new projections will be given, that will be more important. That's why I'm not focusing on this right now. For now, you can remember these percentages, but in the new Monetary Policy Committee meeting, whatever the new reasons will be given, that you have to focus on. Okay. Yes. So the Monetary Policy Committee meeting will be in August, in the starting of the August. So that meeting you have to focus on, that will be near to the examination. Okay. So the RBI for now has projected the real GDP growth to be at 6.5% in 2025-26, same as 2024-25. Now the problems are going to come because of the protracted geopolitical tensions, the extended geopolitical tensions that started from a few countries, Russia-Ukraine war, and now it is spreading to Iran, Iraq, and various other countries. Okay, so the headwinds from protracted geopolitical tension elevated uncertainty around the trade policies and the economic policies, and the trade disruptions between the countries and the weather related uncertainty, they pose the downside risk to growth in our country. Okay, moreover, the deceleration, the decrease that is going to come in the global growth will act as a drag on domestic demand, also will act as a drag on the domestic output also. So if the global growth is going to decrease, that will affect the growth in India also. It is estimated that 100 basis point, that is 1% slowdown in the global growth can affect the India's growth by 30 basis point, that is by 0.3%. So the 1% effect in the global growth, 1% decrease in the global growth will affect the Indian growth by 0.3%. So this is the idea. So the external conditions are going to affect India, though they are not going to create major impact in India, but still they are going to affect India to a certain extent. Okay. Now coming to the next point. So here, so here domestic inflation has been steadily declining with the headline. So the domestic inflation, so inflation in our country has been declining with the headline consumer price index inflation. That means the retail inflation in our country, the retail inflation, that is the consumer price index inflation. This is the inflation that affects the consumers. So this inflation recording a 6-year low of 2.8% in May 2025. You can understand that the target of inflation, the retail inflation target is 4% plus minus 2%. We don't want the inflation to go below 2%. We don't want inflation to go above 6%. So the inflation is 2.8%. That is around 4%, but it is very close to the lower tolerance level. So here you can see that the inflation in our country is very low. So that is a good news, because we have more opportunity to work on growth without worrying about inflation. So domestic inflation has been steadily declining in India, and the retail inflation, the consumer price index inflation, that is the inflation affecting the consumers, recording a 6-year low of 2.8% in May 2025. So we are near to our target. We are not breaching the target of, we are not breaching the 2% to 6% of the range. Okay, so this is the good news for India. Now coming to the fiscal front. So on the fiscal front, the India's public debt levels, primary deficit. Now what is primary deficit? Anyone has any idea about primary deficit? So primary deficit is fiscal deficit minus the interest payments. Okay, so fiscal deficit, I have given you the formula for fiscal deficit. It is the total expenditure minus total receipts excluding borrowing. Okay, so the fiscal deficit shows that the expenditure of the government is higher than the receipts of the government excluding the borrowing. That means government is spending more than its receipts excluding the borrowing. So primary deficit is fiscal deficit minus interest payment. So in the case of India, on the fiscal front, India's public debt levels, the primary deficit and the share of interest payment in the government revenue have remained relatively on the higher side compared to peer emerging market economies. So you can understand that our public debt levels, the primary deficit and the interest to revenue ratio, this is higher as compared to many other emerging market economy countries. So first of all, debt to GDP ratio as a percentage. So debt to GDP percentage in our country is 81.3%. So debt to GDP is 81.3% in India. The primary balance is negative. That means there is primary deficit of 2.3%. The interest expenditure to revenue, the interest to revenue ratio, this is 24.3%. That means out of the revenue of the government, 24.3% is going to for the interest payment. So you can understand that the debt to GDP ratio is high in our country. It is 81.3%. The primary deficit is 2.3%, and the interest to revenue ratio is 24.3%. That means out of the revenue of the government, 24.3% is going for the interest payments. Now these are the negative points about the fiscal front of India. But now coming to the positive side, that India's fiscal position and credibility has enhanced significantly in the recent years because of the fiscal consolidation that we are focusing on. Fiscal consolidation means that the government of India is focusing on reducing the debt and the fiscal deficit. So the focus of government of India is to reduce the fiscal deficit and the debt. That is fiscal consolidation. So government of India is focusing on fiscal consolidation, reducing the debt requirement and the fiscal deficit. So India's fiscal position and credibility has enhanced significantly in the recent years because of the ongoing fiscal consolidation efforts that the government of India is taking. Improvement in the quality of expenditure, where the higher expenditure, we are focusing on more expenditure on the assets. We are focusing on the higher capital expenditure, the expenditure on the assets, as well as the government of India is also focusing on anchoring the debt to GDP ratio for the central government's fiscal policy. So the government of India is focusing on anchoring the debt to GDP ratio at a stable level so that it do not increase very high. So this is the idea, that debt to GDP as the nominal anchor is chosen for the central government's fiscal policy. So we are trying to anchor the debt to GDP level at a stable level. In addition, the government debt. Now this is a very important point to note, that the government debt is predominantly rupee denominated. So in our country, we are focusing more on rupee debt. That means we are taking debt in rupee terms. That will be easier for us to return without the problem of the exchange rate. Okay, so the government debt is predominantly rupee denominated. Now the last point, that is the weighted. If we see the average maturity of outstanding stock of central government market borrowings, so basically the borrowing if the government is doing the borrowing, it has a maturity period. So now the maturity period has increased on average from 10.4 years in 2018-2019 to 13.2 years in 2024-25. That shows that the maturity period has increased. That means the government is taking long-term loans. The government is taking the long-term loans, okay? And around 97% are issued at fixed interest rate rather than floating interest rate, okay? Got it? So this is the basic idea, that the average maturity has increased from 10.4 years to 13.2 years for the borrowings that the government is taking. So government is focusing on long-term borrowing that will be focused on the capital expenditure, and the government is having the borrowing at a fixed rate. 97% of borrowing is at a fixed rate. Okay. Now coming to the next point, that is external sector. Any confusion? Yes, if the rupee denominated loans are taken, so the exchange rate problem, the exchange rate uncertainty will not arise. Okay, let's move forward with the external sector. So we have only few slides, then we will move to the chapter 2. So here the resilience of the external sector. Now do you remember that I have taken a session, the previous session that I took on Tuesday? Here we discussed about the yearly data for the India's external debt and the balance of payment. So this whole slide will talk about the same data, because this is the data, that is the yearly data that the RBI released. Okay, so I hope you remember. Now just tell me, what is the current account deficit? What is the current account deficit for the 2024-25 in the balance of payment? In the balance of payment, what is the current account deficit for the 2024-25? And in the quarter 4 of the 2024-25, there is current account surplus. That is what? As a percentage of GDP, you have to tell me. So this data we have discussed in the previous slide. So I hope, previous session. So I hope you remember that the current account deficit in the 2024-25 was 0.6% or percentage of GDP. That was lower than 0.7% of GDP. This was the current account deficit in 2023-24. Okay, and if you remember that in the quarter 4 2024-25, the current account surplus was there of 1.3% of the GDP. Remember? Very good. So this is the idea. Now let's discuss it briefly. So the resilience of external sector has been a key contributing factor to India's macroeconomic and financial stability. The basic idea is that the domestic demand is sufficient enough in our country that we are not impacted much because of the external factors. Okay, so the resilience of the external sector, and still in India the external sector remained resilient. Okay, we were not much impacted by the external factors. So current account deficit. Now in the balance of payment, you have the current account and you have the capital account. The current account shows you the trade in goods, the trade in services, and the transfer payment. So current account was in the deficit at 0.6% of the GDP during the 2024-25. It remains eminently manageable. So this is manageable. The current account deficit of 0.6% of GDP is manageable, supported by sustained buoyancy in the service export. Now trade in services and transfer payment, we have received huge payments for our service exports. We are doing a lot of service export for which we have got good payments, and the transfer payments, that means we have received the remittances, a lot of remittances from the other countries, from the people that are the Indian people that are living in other countries. Okay, so we have received a lot of remittances from the other countries. So there is sustained buoyancy in the service export and the remittances also. India has received a lot. Now the current account balance turned into a surplus in the quarter 4 of 2024-25, which was 1.3% of the GDP. Okay, so do see this previous session that I have taken on Tuesday. That is just the last session I have taken. So this session will give you the detailed understanding and the detailed data points regarding the India's external debt and balance of payment situation, okay, for the 2024-25. Now, if you remember that the foreign exchange reserves at US dollar 697.9 billion as on June 2025. So this data point you do not have to remember, because again in the Monetary Policy Committee, the new foreign exchange reserves data will be released in August, okay. So basically the foreign exchange reserves, they are sufficient to cover more than 11 months of merchandise imports. So here you can see this diagram. Here you can see that in March 2025, we had enough of the foreign exchange reserves to cover 11 months of the import, the goods import, the merchandise import, and by June 2025 we have enough foreign exchange reserves to cover our goods imports of 11.5 months. Okay, so this is the idea that by June 2025 we have enough of the foreign exchange reserves to cover 11.5 months of the good imports. Now the external debt, I hope you remember this also, we have discussed it in the previous session, that the external debt to GDP ratio was what? Tell me, the external debt to GDP ratio for 2024-25 is what? It has increased to 19.1%, right? So external debt to GDP ratio is 19.1% of the GDP at the end of March 2025, at the end of the financial year, at the end of March 2025. So short-term debt on the residual maturity basis stood at 45.4% of the foreign exchange reserves. This also we have discussed in the previous session. Okay, so these data points become very important because they were released separately in the RBI notification, in the RBI press release, and then they are mentioned again in the financial stability report. So these data points become very, very important. Okay, next is, again this also we have discussed in the previous session, where we discussed that the foreign direct investment has decreased from $10.2 billion to $1 billion. The foreign direct investment, the net foreign direct investment, it has decreased from $10.2 billion to $1 billion. The foreign portfolio investment has also decreased. The external commercial borrowing has actually increased. And the non-resident deposits, the net non-resident deposits have actually increased. Okay, so this is regarding your balance of payment data. Now coming to the next point, that is in regards to the domestic financial market. So you must have heard that the rupee is depreciating, right? But there is a period in which rupee started appreciating also. So let's discuss about this. Okay, so actually during the foreign exchange market witnessed bouts of volatility even as the USD INR exchange rate recorded sharp two-way movements. So we have seen the sharp two-way movements where the rupee started depreciating against dollars, and now the rupee has started to appreciate against dollars. Again, it started depreciating against dollars. Okay, so there was two-way movement during the January to May 2025. If you see in the January 2025, in the December 2024, until Feb 2025, there was depreciation of rupee that was happening. But in the period of March 2025 to April 2025, the rupee started appreciating against the dollars. Why the rupee started appreciating against the dollars? Because there was broad-based weakness in the US dollars. The dollar started weakening. During this time period, due to which the rupee started strengthening. As well as better economic outlook for India has also led to the strengthening of rupee at the global level. Okay, so this is the basic idea, that the pace of rupee depreciation increased in the late 2024. You can see that depreciation, a lot of depreciation was happening in rupee in the late 2024 and the starting of 2025. But in the period of March to April 2025, the rupee started strengthening because of the broad-based weakness in the US dollars and the better economic outlook of India. Okay. Okay, so now coming to the next point. Furthermore, India's weightage in the MSCI. So basically the Morgan Stanley, okay, that is the Morgan Stanley Emerging Markets Index. So Morgan Stanley Capital, like Morgan Stanley, it releases the Emerging Market Index. Now this index, it tracks the performance of the equity market in the emerging markets. Okay, so Morgan Stanley, it releases the emerging market index, that tracks the performance of equity market, that tracks the performance of the large and mid cap equity, the large and mid cap shares in the emerging market. Okay, so furthermore, the India's weightage in the MSCI Emerging Market Index has remained steady at 18.5% as at the end of March 2025. So that means India has a big chunk in the emerging market index. That means India has a big chunk in the emerging market equity performance. This is the basic idea. Okay, so the emerging market index, it tracks the performance of the equity market, the large and mid cap shares in the emerging markets. Okay, So this is the basic idea. So India has the share of 18.5% at the end of March 2025 in the emerging market index. Next point is that the resource mobilization. Now why I am bringing these points? Because they were given in newspapers. Okay. So in the financial stability report, there are certain important points that I will be showing you, as well as from the FSR, there are certain points that are also in the newspaper. So these points might seem not so important because they have come in the newspapers, in the Business Standard and Economic Times, so they become more important also. Okay. So in the FSR, these points are given. Now they become important because they are also in the newspapers. So resource mobilization. Now, if the businesses have to get the money, from where they can get the money? They can get the money from the banks, from the NBFCs, as well as the businesses can get the money from the capital market by selling the shares or by issuing the debt instruments, right? So resource mobilization has happened through the capital market. The government as well as the businesses, they mobilize the resources, they collect the money through the capital market. So the resource mobilization through the capital market grew by 32.9%, in which in the whole resource mobilization, the major chunk was through the debt instruments. Okay. So debt market had the dominant share in the resource mobilization, and the equity market accounted for the rest of the resource mobilization. So debt market had the dominant share of 63.5% in the resource mobilization, and 27.4% money has been raised through the equity market. So this is the basic idea. The next point is that in the debt market, the corporate bond, now again this point was in the newspaper, in the Economic Times. So in the debt market, the corporate bond net outstanding rose to 53.6 lakh crores. Now the important point that you have to keep in mind is that the highest ever fresh issuance has happened in 2024-25 of the corporate bonds, that was of 9.9 lakh crore. Okay. So the important point here is that the highest ever fresh issuance has happened of 9.9 lakh crore worth of corporate bonds during the 2024-25. Okay. Next point is that the RBI has injected durable liquidity. Now, if you remember that there was a lot of discussion that was going on in the starting of the year that there is deficit of the liquidity. That means the liquidity, the money supply is not sufficient in our country. The money supply is not sufficient in our country. The liquidity is in deficit. So RBI had the task to increase the money supply. To increase the money supply, RBI has taken various measures. Okay, that is open market operation purchase. The RBI purchased the government securities from the banks, and RBI gave the money to the banks. RBI gave the rupees to the banks. Okay, so through this open market operation purchase, RBI released the money supply in the economy, as well as RBI started buying the dollars from the banks, and RBI started providing the rupees to the banks. Okay, so RBI came into swap contracts where RBI was buying the dollars currently and providing the rupees, and it was said that after a few months RBI will return the dollars and RBI will take back the rupees. Okay, so you can understand that immediately RBI was releasing the rupees through the swap contracts. So there were various means through which RBI was increasing the liquidity in the economy. So RBI has injected the durable liquidity amounting to about 9.5 lakh crore through different liquidity measures. Open market operation purchase happened where the RBI purchased the government securities from the banks, as well as buy sell swap happened in which RBI was buying the dollars and was selling the rupees through the swap contract. Term variable rate repos. So repo happened, like the variable repo happened through the markets, that the RBI was providing more and more loans through the variable repo rate. So this since January 2025, there were various measures that were taken to increase the liquidity in the economy. Now, do you remember that the CRR has been decreased? So what is the decrease that has come in the CRR? Now, if the CRR is decreased, that means less reserves have to be kept by the banks. So that means they will have more money to lend. So there will be more supply of money to the people, right? So CRR has been decreased from 4% to 3% in 4 equal tranches. So it is said that the CRR will be reduced from 4% to 3% in 4 equal tranches. So this decision has been recently taken in the Monetary Policy Committee June meeting, where the RBI is decreasing the CRR so that the banks have to maintain less reserves and the banks will be able to lend more, right? So this is the basic idea, and the RBI has also reduced the repo rates through the Monetary Policy Committee meetings. Repo rate is decreased so that the banks have, the banks can take the loan from the RBI at lesser rate. So repo rate is decreased so that the banks can take more and more loans from the RBI at lesser rate, and they can provide the money to the people in the country. Okay, so money supply will increase in the economy. Now coming to the last few slides of this first chapter. So first of all, as on end December 2024, India's household debt. Now again, these data points were given in the newspaper, so they become important. As on end December 2024, India's household debt taken by the households, debt taken by the individuals and not businesses we are talking about. Okay, so household debt was 41.9% of the GDP at the current market price. This was relatively low compared to the other emerging market economies. Among the broad-based categories of household debt, the non-retail loans were the highest. Okay, so among the broad categories of household debt, non-housing retail loans, that means the personal loans, credit cards, consumer durable loans for your sofa, for your bed, for your fridge and such. So consumer durable loans and the other personal loans, they were the highest category. So in the household debt, if we exclude the housing retail loans, so non-housing retail loans were the highest at 54.9%. Okay, the housing loans were 29% of the total household debt. So in the household debt, non-housing retail loans were 54.9%, the highest. After that, it was housing loans, that was 29%. Okay. Now coming to the next point, that is in the housing loans on the other hand form 29% of the household debt. Now the increase that has happened in the housing loans, that was because of the existing borrowers that were taking additional loans. So incremental growth, the growth that has happened in the housing loan has been mainly driven by the existing borrowers who are availing additional loans, and their share has increased to more than one third of the housing loans sanctioned in the March 2025. So you can understand that the growth that has happened in the housing loan, that is because of the existing borrowers that are taking the additional loan, and they are becoming one third of the housing loans that is sanctioned in the March 2025. Share of borrower accounts with loan to value ratio. So loan to value ratio is the loan that is getting sanctioned divided by the collateral value, the value of the collateral. Let's say your house is the collateral that has the value of 10 lakh. So 70%, that means 7 lakh rupees will be given to you as loan. So loan to value ratio is the loan to collateral value. So if the collateral value, the house value is 10 lakh, so 70% of that is given. That means 7 lakhs is given as loan. So now the share of borrower accounts with loan to value ratio greater than 70% is also rising. So this can be problematic, because if more loan is given compared to the collateral value, so it can lead to the like when the default happens and the house value decreases because of, let's say, the price decreasing at the domestic level, so then it can be problematic because the banks will not be able to raise much by selling the house. Okay, so this is the idea that out of the total household debt, non-housing retail loans have the highest percentage in the household debt, that is 54.9%, and then housing loan have 29%, and the incremental growth that is coming in housing loan, that is because of the existing borrowers. Now as at an aggregate level, the per capita, that means per head debt of individual borrowers has grown from 3.9 lakh rupees in March 2023 to 4.8 lakh rupees in March 2025. Okay, so you can see that the per head or on average the loan is increasing on the individuals, and the rise in per capita debt has been mainly led by higher rated borrowers. So that is good, because the higher rated borrowers, that is good borrowers, are taking the loans. Domestic financial markets. So here, according to the Financial Stability Board, now Financial Stability Board is an international body. So this is the last slide for your first chapter. So the Financial Stability Board, it is an international body that monitors and makes recommendation about the global financial system. Okay, so Financial Stability Board, this is an international body that monitor and makes the recommendation about the global financial system. Now, according to the Financial Stability Board, out of the total global financial assets of $486.4 trillion, this is the global financial asset. Out of the total global financial asset at the end of December 2023, the share of non-banking financial intermediaries have increased to 49.1%, growing at more than double the pace of banking sector. So out of the total financial assets, 49.1% is under the non-banking financial intermediaries, that is increasing by double the pace of the banking sector. Okay, so this is regarding the data point that is given from the Financial Stability Board. Now coming back to the domestic data. So asset quality has shown improvement. Now this domestic data, we are going to discuss about the micro, small and medium enterprises. So if any question comes on the micro, small and medium enterprises, you can use this data points, this financial data point. Okay, so first of all, asset quality has shown improvement with gross non-performing asset ratio in the micro, small and medium enterprise portfolio of the scheduled commercial bank falling from 4.5% to 3.6% at the end of March 2025. So basically the asset quality has improved because the gross non-performing asset in the micro, small and medium enterprise category for the scheduled commercial banks, gross non-performing asset is decreased from 4.5% to 3.6%. So you can understand that in the MSME category, the loans that are given by the scheduled commercial bank, the gross non-performing asset has decreased from 4.5% to 3.6%. So if the non-performing asset is decreasing, that means it shows that the MSME segment is becoming healthy. Okay. Now next part is that within the MSME sector, however, the credit to the micro enterprise, which form 49% of the total credit. So in the total credit to the MSMEs, 49% was given to the micro enterprise. Okay, so in the micro, small and medium enterprise category, the 49% of the total credit to the MSME sector was going to the micro enterprise. This witnessed slower incremental growth. That means the growth was happening in the loans that were given to the micro enterprises, but the growth is not very fast. The increment growth is slower. So slower incremental growth is seen in 2024-25 to the micro enterprise as compared to the small and medium enterprise. Okay, so a large chunk of the loans that is given to micro, small and medium enterprise, out of that large, out of the total loan that is given to micro, small and medium enterprise, the large chunk is given to micro enterprise, but the growth that has happened in the loans to micro enterprise is not much. Okay, in terms of amount outstanding, the share of subprime borrowers. Now let's discuss the subprime borrowers. So subprime borrowers are the borrowers that do not have they do not have the regular capacity to repay. There are prime borrowers. The prime borrowers, they have good credit rating, they have regular source of income through which they can pay back the loans. Okay, so these are the prime borrowers, these are the good borrowers, good credit rating, regular source of income to repay the loans. Now there are subprime borrowers. Okay, they have the bad credit rating, or they have the credit rating is not present, the history is not present, or the credit rating is not present because the person or the entity has not done much financial transactions. That's why the clear credit rating is not present. So either the bad credit rating or lower credit rating or credit rating is not present, and the regular source of income is also not present in some cases. So that is subprime borrower. So in the case of micro, small and medium enterprises, because these are small vendors, these are small enterprises, so in certain cases the credit rating is not present. Then also the loans are given to these small vendors so that they can start their business or they can continue their business. Okay, so in terms of amount outstanding, the share of subprime borrowers in the MSME portfolio of the scheduled commercial bank has decreased from 33.5% in June 2022 to 23.3% in March 2025. Okay, so I hope this is clear that the subprime borrowers in the MSME portfolio are decreasing for the scheduled commercial bank from 33.5% to 23%. Now coming to the next point, here you can see that the credit growth in major sectors. So in the retail sector, you can see that there is a huge growth, and in the MSME sector. Okay, so out of the total credit that is given by the scheduled commercial banks, the highest credit has gone to the MSME sector, or the highest credit growth has been to the MSME and the retail segment. Okay, so basically the total growth of the credit. So let's say the loans have increased by 10%, or let's say loans have increased by 100 rupees. So out of that increase in the credit, out of the increase that has happened or the growth that has happened in the credit, the highest chunk has gone to the MSME and the retail segment. Okay, So this is the idea. Now this is about the growth and not about the total we are talking about. Okay. So the credit growth in the major sectors. So the highest growth has been seen in the MSME sector and in the retail segment, the credit growth. Now the asset under management. So the last point for the first chapter is that the asset under management of the domestic mutual funds industry continued to grow and reached a record high of 72.2 lakh crore in May 2025. So asset under management of the domestic mutual fund is quite high, that you can see it has continued to grow and has reached to the record high of 72.2 lakh crore in May 2025. Okay. So this is the data for the mutual funds. Now coming to the chapter 2. Any confusion, any problem in chapter 1? Any confusion, any problem in chapter 1? Now chapter 2 is all about the data of the scheduled commercial banks, the primary urban cooperative banks and the non-banking financial companies. Okay, so let's start with the data for these entities. So Indian banking sector has remained robust with the capital buffers at a record high, non-performing loans, that is NPAs ratio at multi-decadal low. So let's see the data for the scheduled commercial bank first. So starting with the deposit growth. Okay, so scheduled commercial bank aggregate deposits grew at 10.7% year on year during 2024-25. So basically the deposit growth is 10.7% for all the scheduled commercial bank. This is the year on year data that we are seeing. That means we are comparing March 2025 with the March 2024, and from March 2024 to March 2025 there is the deposit growth of 10.7% that the scheduled commercial bank has got. Okay, even though you can see that for the public sector banks the growth rate, the deposit growth has increased, but for the private sector banks and foreign banks the deposit growth has decrease. That means growth is happening, the deposit growth is happening, but by a lesser percentage as compared to previous year. Okay, so this is the idea, that as compared to previous year, as compared to March 2024, in March 2025 the deposit growth has happened by a lesser percentage. So deposit growth is happening but by a lesser percentage. Now this is the idea about the deposit growth. Remember that the scheduled commercial bank aggregate deposits have grew at 10.7% as compared to the previous year, and the notwithstanding a deceleration has happened. That means the growth has happened, but the growth has happened by a lesser percentage in the private sector banks and the foreign banks. Now coming to the term deposits. So term deposits, they are the time deposits, that is for a period of time. So they have a maturity. So the time deposits like the fixed deposit, the recurring deposit that you are doing for a period of time, they have a maturity, right? So fixed deposit and recurring deposit, they have a higher share. So growth in term deposit, the growth that has happened in the term deposit continue to outpace that in current and saving account deposits. So you can see that the growth in the term deposit category is higher than the growth in the current account or saving account. Okay, so the growth in term deposits is way higher than the growth in the current account and saving account. Now coming to the next point, that is credit growth. So scheduled commercial bank has got the credit growth of 11% as compared to the previous year. So in 2024-25 the credit growth in the scheduled commercial bank is 11%, but it is lower than the previous year. So the growth has happened in the credit growth has happened, but that is lesser than the last year. Okay, now coming to the next point, that is composition of credit portfolio. So out of the total credit that is given by the scheduled commercial bank, the highest credit has gone to the service sector and to the personal loans. Okay, so out of the total loans, out of the total credit portfolio, the highest credit has gone to the service sector and the personal loan. So here also you can see that in the case of credit growth of select sectors for the scheduled commercial banks, for the scheduled commercial bank, the credit growth has been highest in the service sector and in the personal loan category. Okay, so credit growth of public sector banks outpace that of private sector banks. So here also you can see that the public sector banks credit growth is higher than the private sector bank. Okay, so public sector bank credit growth is higher than the private sector bank, and the personal loan and service loans, they continue to remain the top two contributors to the overall credit growth of the scheduled commercial bank. So credit growth of select sectors. So the scheduled commercial bank, in the case of scheduled commercial bank, the credit growth is quite high in service sector and personal loan category. Okay, so this is the idea. Now coming to the next point, that is scheduled commercial banks continue to record improvement in their asset quality. So the asset quality has improved for the scheduled commercial bank. That means the scheduled commercial bank has seen a decline in the gross non-performing asset and the net non-performing asset. So for the scheduled commercial bank, the gross non-performing asset has reduced to 2.3% for all the scheduled commercial bank. This is the data. For the scheduled commercial bank, the net non-performing asset ratio has decreased to 0.5%. Okay. So you have to remember the deposit data, that is the deposits have grown by 10.7%, as well as the term deposits are growing more than, or the growth rate in term deposit is higher than the growth rate in current account and saving account deposits. Okay. Next is that the credit growth has been 11%. So the credit growth is 11%, and the credit growth like it is as per the portfolio, credit portfolio, the service sector and the personal loan, these have got the highest loans, as well as these credit growth has been highest in the service sector and the personal loan. So these have also got the highest credit growth in the sector wise. Okay. Now coming to the gross non-performing asset. So the total non-performing assets have decreased to 2.3% for the scheduled commercial bank in March 2025, and the total or the net non-performing asset, the net non-performing asset has decreased to 0.5% in the March 2025. Okay. So this is the idea. So scheduled commercial bank continue to record improvement in their asset quality, with the gross non-performing asset ratio and the net non-performing asset ratio declining to multi-decadal low of 2.3% and 0.5% respectively. Agriculture sector continued to record the highest gross non-performing asset ratio and was the major contributor to the overall stock of gross non-performing asset. Okay. So here coming to the slippage ratio. See, slippage ratio is the new NPAs that have been created. So let's say in this financial year from March 2024, or let's say from 1st April 2024 till 31st March 2025. So in this financial year, how many of the standard assets have converted into the stressed assets or the non-performing assets? So that is the slippage ratio. That means how many new loans or how many loans have converted into the non-performing asset or the stressed asset in this coming financial year, in this new financial year. Okay. So the slippage ratio, it shows that it shows the new assets or the standard assets that have converted into the non-performing asset in the current financial year. So the slippage ratio, the half yearly slippage ratio was 0.7% for the scheduled commercial bank. Okay. And provisioning coverage ratio, this is like out of the total gross non-performing asset, let's say gross non-performing asset is 100 rupees. Okay. Out of this, the banks have the provision of 76.3. Okay. So the banks are maintaining certain provisions to cover their gross non-performing asset. So the provisioning coverage ratio shows that out of the total gross non-performing asset, how much is covered through the provisions, how much is getting covered through the provisions. Okay. So slippage ratio, this is the standard assets that are converting into the non-performing asset in this current financial year. How many of the loans have converted into non-performing asset? So that is shown by slippage ratio. Provisioning coverage ratio shows that out of the total gross non-performing asset, how much is getting covered through the provisions maintained by the bank. Any confusion? So here now coming to the next point. So a large borrower, first of all, a large borrower is defined as one who has aggregate fund-based and non-fund-based exposure of 5 crores and above to any single scheduled commercial bank. That means a large borrower is the borrower that has taken the aggregate fund-based, that is has taken the money in the form of borrowing and such, or non-fund-based, that means he has taken the letter of credit, or let's say he has taken some guarantee worth rupees 5 crore and above. So if the total, a large borrower is defined as one who has taken the total fund-based and non-fund-based exposure of 5 crore and above to any single scheduled commercial bank, will be considered the large borrower. Now the share of large borrower in loans and gross non-performing asset. So the total share of large borrowers in the gross advances is 43.9%. That means out of the total credit of the bank, the large borrowers have the share of 43.9%, and out of the total gross non-performing assets, the share of the large borrowers is 37.5%. Okay. Now GNPA ratio of large borrowers. So the GNPA ratio of large borrowers has declined from 3.8% in September 2023 to 1.9% in March 2025. Okay, so basically here the gross non-performing asset ratio for the large borrowers has decreased from 3.8% in September 2023 to 1.9% in March 2025. So for the large borrowers, the gross non-performing asset has reduced. Okay, so this is the idea. Any confusion? Anyone? Next is capital to risk weighted asset ratio. Okay, so we have discussed the GNPA data, NNPA data. Now coming to this capital to risk weighted asset ratio. So capital to risk weighted asset ratio is the risk weighted assets. So all the assets of the bank, the asset of the bank is the loan that the bank is providing. Okay, so the loan that the bank is providing, let's say the loan is worth 1 lakh rupees. Now this loan has certain risk attached. If the loan is given to the central government, there is 0% risk. If the loan is given to state governments, let's say there is 10 or 20% risk. If the loan is given, so if the loan is given to corporates, there is, let's say, 30%, 40%, 100% risk. If the loan is given to MSMEs, there is certain percentage of risk. Okay, so all the assets, that is all the loans that is given by the bank, they have some risk attached. Okay, so against the risk weighted asset, the banks have to keep certain capital so that the banks are able to handle any kind of distress situation. So this is the capital to risk weighted asset ratio. So banks have to maintain the capital. The banks have to maintain the capital against the risk weighted asset. So this is the capital to risk weighted asset ratio. Okay, so usually the CRAR for the banks is 9%. That means if the risk weighted asset is 100 rupees, so 9 rupees of capital, this is the capital that the bank has to maintain. Okay, so this is the capital to risk weighted asset ratio. Now as of March 2025, the capital to risk weighted asset ratio of the scheduled commercial bank has increased to a record high of 17.3%. So here you can see that the CRAR has increased. For the scheduled commercial bank, the CRAR, the capital risk weighted asset ratio, has increased to 17.3%. All the bank groups reported higher CRAR in March 2025. For the public sector banks, the private sector banks and the foreign banks also, they all have recorded the higher capital to risk weighted asset ratio. All the bank groups reported higher CRAR. Okay, now coming to tier 1 leverage ratio. So tier 1 leverage ratio, this is the tier 1 capital to the total exposure. So first of all, try to understand that the capital to risk weighted asset ratio, that has to be maintained. Let's say 9% of the capital to risk weighted asset ratio has to be maintained by the bank. So the capital that the bank is maintaining, it is maintained in tier 1 capital or tier 2 capital. Now the tier 1 capital is considered the liquid capital that the bank can use during the distress situation. Okay, so the capital that the bank has to maintain against the risk weighted assets, that is maintained in tier 1 capital or tier 2 capital. Tier 1 capital is considered the liquid capital. So tier 1 leverage ratio is the tier 1 capital divided by the total exposure of the bank. So tier 1 leverage ratio is higher at 7.9%. That means tier 1 capital to the total exposure is good. Okay, it is 7.9%. Now coming to the common equity tier 1 capital. So out in the tier 1 capital, there is common equity tier 1 capital, that is the most liquid kind of capital that the banks have. Okay, so tier 1 capital is liquid capital, but in the tier 1 capital, the common equity tier 1 capital is the most liquid capital that the banks have, that the banks can use during the distress situation. So here you can see that the common equity tier 1 capital is also quite high with the banks, that is 14.7%. Okay, with the scheduled commercial bank. So this is the data point that you have to remember. Now coming to the profitability percentages. So profitability of the scheduled commercial banks remained strong in 2024-25 with profit after tax. After paying the tax, the profit increased by 16.9%. So profit after tax of the public sector banks were higher as compared to the private sector banks, because the public sector banks earned more through their other operating income, that is through their investments and such. The public sector banks were able to earn more. Okay, now coming to the net interest margin. Okay, I will come to your query, Ritik, but try to understand here. Net interest margin. So this is the interest that is earned by giving the loans. Okay, minus the interest that is paid on the deposits. Okay, so let's say the interest that is paid on the deposits is 100 crores. while the interest that is earned on loans is 200 crores, okay, divided by the total exposures of the bank or the average exposures of the bank. So this is net interest margin. This is net interest margin. That is seeing the difference between the net interest margin. It sees the difference between the interest that is earned by the banks minus the interest that is paid by the banks. So that is net interest margin. So that is 3.5%. Okay. So this is the net interest margin annualized in the percentage form. So that is 3.5%. That is interest, positive interest has been earned. Okay. Next is return on equity in the percentage form. So return on equity is 13.6%. Return on equity is the shareholder, like the returns that the shareholders have got. So it is 13.6%. Return on assets. Return on assets means that from the asset of the bank, how much the bank has been able to earn. So it is 1.4%. Okay. So you can understand that the net interest margin, the return on equity and return on asset, they are positive. That means the bank has been able to earn more. Got it? Now this is the summary of the data for the scheduled commercial bank. Before that, I will answer Ritik. So Ritik, the data in the annual report was for the balance of payment April to December, I think. And in the financial stability report, the data for the balance of payment is from April to March. That means for the whole financial year of 2024-25. Okay. So in the annual report, the data was from April 2024 to December 2025. While in FSR, the data for balance of payment is from April 2024 to March 2025. That is for the whole financial year. That data is in FSR. Now, coming back to the data points. So, the gross advances that is given by the scheduled commercial bank in lakh crore is 181.3 lakh crore in March 2025. The gross non-performing asset percentage is 2.3% and the net non-performing asset percentage is 0.5%. Then return on asset percentage is 1.4% that we have just discussed, that return on asset is 1.4% in March 2025. The CRAR, capital to risk weighted asset ratio for the scheduled commercial bank is 17.3%, while the liquidity coverage ratio. So liquidity coverage ratio, this we have discussed previously also. So liquidity coverage ratio, this shows that how much the liquidity the banks have against the net outflows in the coming 30 days. So in the coming 30 days, there are going to be the outflows. The depositors are going to take away their money. Okay. So against the net outflows in the next 30 days, how much of the liquidity, how much of the high quality liquid assets the bank has. So this is liquidity coverage ratio. This is the value of high quality liquid assets that the bank has in the form of cash, in the form of government securities and such. So how much of the high quality liquid asset the bank has against the net cash outflow that is going to happen in the next 30 days multiplied by 100. So this is liquidity coverage ratio, that how much liquidity coverage the banks have. So banks, scheduled commercial bank have the liquidity coverage of 132.6. That means if the people are going to take away 100 rupees in the coming 30 days, so the banks have 132.6 worth of liquidity. So banks have enough liquidity to provide the money to the depositors. Okay. So liquidity coverage ratio is good. Provisioning coverage ratio, that is the provisions that the banks are maintaining against the gross non-performing asset. So that is 76.3. And the slippage percentage. Now the slippage percentage, if you remember, for the half yearly was 0.7%. So for the annual, slippage percentage will be 1.4%. That means the standard assets that have converted into the stressed assets or non-performing asset in this financial year. So the slippage ratio is 1.4%. The annualized slippage ratio, it is 1.4%. Any confusion now? Now coming to the macro stress test for the scheduled commercial bank. So here the macro stress test aim to assess the resilience of the banking system, that is in the coming 2 years how resilient the banking system is going to be. Okay. So the test project the capital ratios of banks under 3 stress scenario. Baseline scenario, that means the scenario in which stress is not there, the normal situation. Then there is adverse scenario 1 and then there is adverse scenario 2. Okay. So basically the test, the macro stress test, this test project capital ratio of banks under 3 scenarios, the baseline and 2 adverse macro scenarios over a 2-year horizon. That means in the coming 2 years, what will be the capital ratios in the normal situation, in the adverse situation 1, in the adverse situation 2. So adverse scenario 1 takes into account the geopolitical risk scenario. That is, if there is tensions that increase between the countries, the geopolitical tension increase. So in this case, the geopolitical risk are heightened, escalation of global financial market volatility, the supply chain is getting disrupted because of the war that is going on between the countries, or because of the geopolitical tensions, maybe the supply chain will be disrupted. So in this scenario, what will be the capital ratios, what will be the capital that the scheduled commercial banks will be able to maintain? In the adverse scenario 2, that is, if the global growth is further slowing down, and that slowdown in the global growth will affect the growth of India also. So in this case, what capital ratios the banks will be maintaining? Okay, so that we have to see. So first of all, the macro stress test has been done of 46 major scheduled commercial banks. So 46 major scheduled commercial banks have been taken for the macro stress test. Okay, now here in March 2025, in these 46 scheduled commercial bank, the capital to risk weighted asset ratio is 17.2%. Now here, if you see for the scheduled commercial bank, the capital to risk weighted asset ratio is 17.3. But if we see for 46, only we are taking the 46 scheduled commercial bank, not all. So for 46 scheduled commercial bank, the capital to risk weighted asset ratio in March 2025 is 17.2%. That is going to decrease, that is expected to decrease, that's projected to decrease to 17% in the baseline scenario, in the normal scenario by March 2027. In the adverse scenario 1, it is expected that the CRAR will decrease to 14.2%, and in the adverse scenario 2, it is expected that the CRAR will be at 14.6%. So here you can see that none of the banks would fall short of the regulatory minimum requirement. So regulatory minimum requirement of the CRAR is 9%. That means the banks have to maintain the minimum CRAR of 9%, but the banks will be able to maintain way higher than 9% of the CRAR. Okay, so banks will be in a good position even if there is adverse scenario 1, or even if there is adverse scenario 2 that comes in by March 2027. In the case of common equity tier 1 capital, that is the most liquid kind of capital that the banks have. So the 46 banks are said to be currently having 14.6% of the common equity tier 1 ratio, which will increase to 15.2% by March 2027 in the baseline normal scenario. It might decrease to 12.5% in the adverse scenario 1, and it might increase to, like, it will be at 12.9% in adverse scenario 2. So the common equity tier 1 capital, the minimum requirement is 5.5%. So you can understand that the common equity tier 1 ratio requirement for the banks is 5.5%, but the banks will be able to maintain way higher than the 5.5% even in the adverse scenarios. Okay, coming to the GNPA ratio, it is expected that the GNPA ratio might increase to 2.5% in the baseline scenario for these 46 scheduled commercial bank, and it might increase to 5.6% in the adverse scenario 1 and to 5.3% in adverse scenario 2. So the GNPA ratio can increase. Okay, so this is the idea. Now coming to the primary urban cooperative bank, so I will give you the direct data points here, because we have discussed about the CRAR and the return on equity, return on asset for the scheduled commercial bank. So now you will get the data points for the primary urban cooperative bank. Remember the data point. So credit growth for the primary urban cooperative bank in March 2025 was 7.4%. The CRAR that the urban cooperative banks were able to hold was 18.0%. That is way higher than the minimum requirement that the primary urban cooperative bank has to maintain. Okay, so there is minimum requirement of the capital to risk weighted asset ratio that the primary urban cooperative banks have to maintain. So the CRAR that the primary urban cooperative banks were maintaining was 18%. Okay, the tier wise capital to risk weighted asset ratio. Now remember that the tier 1 urban cooperative banks are small urban cooperative banks, so they have to maintain 9% of the CRAR. Okay, but they were maintaining 20.5% of CRAR. Now tier 2 to tier 4 UCBs, they are the bigger UCBs, they have to maintain 11% of the CRAR, and by March 31st 2026 they have to maintain 12% of the CRAR, and they were maintaining higher CRAR than their requirement. So you can understand that the banks, now the tier wise data you don't have to remember, just remember the overall data of the urban cooperative banks. They were maintaining the 18% of the CRAR while their requirement is 9% for the tier 1 urban cooperative banks and 11% for the tier 2 to tier 4 urban cooperative banks. By March 31st, 2026, they have to maintain, tier 2 and to tier 4 UCBs have to maintain 12% of the CRAR. Okay. Coming to the GNP ratio, so that has decreased to 6.1%. So gross non-performing asset ratio for the urban cooperative banks has decreased to 6.1%. The net non-performing asset ratio has decreased to 0.6%, as well as provisioning coverage ratio. That means out of the gross non-performing asset that the banks have, the provisions that the banks is maintaining, the urban cooperative bank is maintaining is 91%. So that is very good. That the bank is urban cooperative banks have higher, very good provisions for the gross non-performing asset. Okay. The net interest margin is 3.6% for the urban cooperative banks, and the return on asset is 0.7%. Return on equity is 6.6%. So gross non-performing asset ratio of large borrowers in the primary urban cooperative banks. So the gross non-performing asset ratio of large borrowers who account, now large borrowers, they account 23.2% of the UCB's loan book, and their gross non-performing asset has reduced. The large borrowers gross non-performing asset has reduced, okay, significantly in the March 2025. So here you can see that the GNP ratio of large borrowers have reduced to 8.9%. This is the idea. Now coming to the NBFCs. Any confusion till now? Scheduled commercial bank, they are the big banks, okay. Yes, scheduled commercial bank has the public sector bank and the private sector bank, foreign banks also, okay. Now coming to the non-banking financial companies. So the credit growth, the total credit growth that has been seen by the NBFC upper layer and middle layer. So the NBFCs are divided into 4 layers: base layer, middle layer, upper layer and top layer, okay. So majorly the data for the NBFCs have been given middle layer and upper layer, okay. For these 2 layers, the data has been given by the RBI. So basically here you can see that the credit growth for the NBFC upper layer and middle layer was 20.7% for March 2025. Now the activity based credit growth of NBFCs. So the credit growth, the highest credit growth has been seen by the investment and credit companies, okay. So that is NBFC, ICC have seen the highest credit growth of 24%. But if you see from the previous periods, the infrastructure finance companies have also seen a huge credit growth, okay. So this is the idea. Now for microfinance institutions, because the microfinance sector is under stress, so for the microfinance institutions, they have decreased their credit growth and their credit growth is in negative. This is the idea. Now coming to the next point, that is the credit growth of select sectors. So agriculture sector has seen a negative credit growth, while the service sector and the others, they have seen a positive and quite high credit growth from the NBFCs, okay. So this is the idea that the credit growth has weakened across all major sectors excluding the services and the others. So services sector and the other sector, this has seen the higher credit growth. The credit in agriculture sector contracted, it has decreased. That you can see that the credit growth in the agriculture sector has decreased, has become negative. Microfinance or the self-help group loans within the retail advances category has contracted. So microfinance loans have decreased because of the stress in the microfinance sector, and the microfinance institutions are giving less of the loans, okay. This is the idea. Now coming to the GNPA ratio, the gross non-performing asset ratio for the NBFCs is 3%. The provisioning coverage ratio for the NBFCs is 66.2%. The GNPA ratio at sectoral level is this. You can understand that the highest of the GNPA ratio is in agriculture. At the sectoral level, the highest GNPA is in agriculture sector, okay. Now the GNPA ratio of government owned NBFCs improved to 1.4%. That means the GNPA ratio has decreased for the government sector. For the government owned NBFCs, the GNPA has reduced to 1.4%, okay. So this is the idea. Now coming to the next point, that is capital adequacy and profitability. So the CRAR, that is the capital to risk weighted asset ratio, that is the capital adequacy that the NBFCs are maintaining. So the capital adequacy is for 25.8%. So the NBFCs are maintaining the capital to risk weighted asset ratio of 25.8%, okay. The net interest margin is 5.2% that the NBFCs are maintaining, and the return on asset is 2.4%. The return on equity is 10.6%. Okay. Now the system level capital to risk weighted asset ratio of NBFCs was healthy at 25.8%. This is quite good in March 2025. Okay. Now coming to the macro stress test. So just like the scheduled commercial bank, for the NBFCs also there was macro stress test that was done. So credit risk in NBFCs system level. So it was seen that system level stress test has happened under a baseline scenario and 2 stress scenarios for 158 NBFCs, and in the scheduled commercial bank 2-year time period was taken, but for the NBFCs only 1-year time period is taken, and the data is shown for March 2026. Okay, for March 2026. So here you can see that over a 1-year horizon, the stress test has happened for 158 NBFCs, where it has been seen that in the baseline scenario, the CRAR will be 21.4%, which will decrease to 20.6% in the medium risk, and in the high risk it will decrease to 20.4%. So there will not be much difference that will come in the CRAR. Okay, but the GNPA ratio will increase from baseline 3.3% to 4.5% in medium and to 5.8% in high, and the number of NBFCs, that will be number of NBFCs for which CRAR is declining below the regulatory minimum, that will be 15 in case of high risk. For 15 NBFCs, the for these 15 NBFCs, the CRAR will decline to the below the regulatory minimum. Okay, so for 15 NBFCs during the high risk, the CRAR will decline to the below the regulatory minimum, but on average the NBFCs on average as a group, they will be able to maintain the CRAR of 20.4%, but for 15 NBFCs the CRAR in the high risk category will come below regulatory minimum. Okay, so this is the basic idea. Here you do not have to focus on the data points much, but remember that for the non-banking financial companies also the stress test has happened in 1-year horizon, in 1-year time period, that is for the March 2026 we can say, and 158 NBFCs have been taken for the stress test, and it has been identified that the CRAR, overall CRAR for the NBFCs will remain above the regulatory minimum even in the high risk category, but 15 NBFCs will come under the, for 15 NBFCs the CRAR will decrease below the regulatory minimum in the high risk category. Okay, so this is the idea. Now coming to the mutual funds and insurance sector. So we are towards the end of the second chapter now. So the SEBI. Now any confusion in here first? Any confusion here? Net interest margin is your net interest margin. It takes into account the interest earnings that the bank has minus the interest expenditure that the bank is doing. So bank has to give the expenditure on the deposits, right? The bank has to give the interest on the deposits, and the bank earns the interest on the loans, okay, divided by the average exposure of the bank. So this is net interest margin, that sees that how much more the interest is being earned by the bank as compared to the expenditure that the bank is doing, the interest expenditure that the bank is doing. This is the idea. Okay, next point, coming to the mutual funds and insurance sector. So SEBI, that is Securities and Exchange Board of India, has mandated that asset management companies should carry out stress testing of all the open-ended debt schemes. Open-ended debt schemes means that you can enter the debt scheme whenever you want, okay, at the time the debt scheme is running. Except overnight schemes, because they finish overnight, they are the one-day schemes only. Every month, so every month there should be stress tests that should happen for the open-ended debt schemes. This is the basic idea. Now coming to the solvency ratio for the insurance sector, okay. So the insurance sector, the IRDI, that is the Insurance Regulatory Development Authority of India, has said that the insurance companies should have the solvency ratio of 150. They should have the solvency ratio of 150%, okay. What is the solvency ratio? This is the asset to the liability. This is the asset that the insurance companies should be maintaining against their liabilities. You know that the insurance companies you know that the insurance companies, they provide the insurance and they have the contingent liabilities. They have the contingent liabilities. These are the future liabilities, kind of, okay? That is, in the future, the liabilities or in like tomorrow or day after tomorrow, there might be many liabilities that can come to the insurance company because of, let's say, some accident has happened and the person has the insurance, so the insurance company will have to pay the liability, okay? So against the liabilities of the insurance companies have to maintain the asset so that the insurance company have enough of the money to pay for the liabilities, okay? Let's say tomorrow I am falling sick and I have to be hospitalized, so I will call my insurance company to get the money for my hospitalization. Or let's say some accident has happened and I will call my insurance companies to pay for the damages, okay? So these are the liabilities of the insurance company, and the insurance company have to cover the payments, right? So the insurance company should maintain the asset against their liabilities. So if the insurance company is thinking that the liability will be 100 rupees, the company should maintain the asset of 150 rupees as per the IRDI. So as per the IRDI, the insurance companies have to maintain higher assets against their liabilities, okay? Any confusion? So here, as of December 2024 and the previous 3 quarters, the aggregate solvency ratio for insurance companies remained above the prescribed threshold of 150%. So the solvency ratio of the life insurance companies remained at, for the life insurance sector, for the life insurance companies, the solvency ratio remained at 204%. That is way higher than the 150% that the IRDI has notified. As well as for the non-life insurance companies, for non-life insurance sector, the solvency ratio remained at 166%, that is higher than 150%, okay? Got it? Any confusion here? Now coming to the interconnectedness. So the financial system can be visualized as a network, okay? So the banks, the NBFCs, they are the nodes. So there are different financial entities that are the nodes, and the loans that they are giving to each other. The banks are giving loans to NBFCs. The NBFCs are taking the loans, or they are doing the investment in bank, or the banks are doing the investment in NBFCs. So there is the linkage that is happening between different banks and the different NBFCs, okay? So the financial system can be visualized as a network where financial institutions, they are connected with each other through the links in the form of loans to investment deposits with each other, which act as a source of funding, liquidity, investment and risk diversification. So if the financial systems, they are interconnected, that means their problems also can get interconnected. So first of all, the total outstanding bilateral exposure among the select 229 entities in the Indian financial system expanded at a growth rate of 19.6%. That means the interconnectedness and the bilateral exposure is increasing between the entities in India, okay? Here you can see that the bilateral exposures have increased to 19.6%. So there is the growth that has happened of the bilateral exposures by 19.6%, and the highest, the share of different groups, so highest bilateral exposure or the highest share is of banks, scheduled commercial banks. After that, the second highest is of the NBFCs, and then asset management company, mutual funds and such. So the highest share of in the bilateral exposure is of scheduled commercial banks. That means the scheduled commercial bank have the most interconnectedness with the other entities, okay? The next is, here you can see that the instrument wise exposure. So through the loans and advances, there is the maximum exposure, or there is a very high exposure that has happened through the loans and advances. After that, the high exposure is because of the capital and equity investments that the banks have done in the other entities and the other entities have done in the banks. So there is exposure. So basically the exposure, the bilateral exposure that the different entities, financial entities have, they are because of the loans and advances, and then due to the capital or due to the equity instruments, and third due to the debt instruments, okay? Through the long-term debt instruments. So this is the basic idea, that there is huge interconnectedness between the entities, and the bilateral exposure of the different entities have increased by 19.6%. The highest share in the interconnectedness or the bilateral exposure is of scheduled commercial bank, and these are the three things that you have to remember, that the instrument wise exposure is because of loan and advances, equity investments or capital investment and the long-term debt instrument investment. Okay, the interbank exposure stood at 3.4% of the total asset of the banking system in March 2025. Now, if the banks are linked, that means there is contagion analysis also, or there is contagion also that can create. So basically, if the banks are linked with each other, if the NBFCs are linked with the banks, if the NBFCs are linked with each other, so there can be contagion that can arise. So contagion analysis uses the network technology to estimate the systemic importance of different financial institutions and the failure of a financial institution, how it will impact the banks or the banking system altogether and the financial system altogether. So the failure of a bank or a failure of the NBFC, how it can affect the whole of the banking system. So that is understood under the contagion analysis. So contagion analysis of the banking network as at the end of March 2025 position indicated that the hypothetical failure of the bank that has the highest interconnectedness or the bank with the maximum capacity to cause contagion loss would cause a solvency loss of 3.4% and the liquidity loss of 0.3%. Okay, so basically if a bank fails and the bank has the high maximum capacity for the contagion loss, so it will cause the solvency loss. Solvency loss means decrease in the asset value of the banks or decrease in the asset value of the banking system. Solvency loss will be in the form of decrease in the trust of the people, and the solvency loss can also happen in the form of, let's say, the liquidity loss will be in the form of decrease in liquidity with the banks, decrease in the reserves of the banks and such. Okay, so this is the basic idea. Any confusion here? Any confusion, anyone? So see, if the bank is failing and this bank is failing that has the maximum capacity, if the bank is failing that has the maximum capacity to cause contagion loss, it will create the solvency loss of 3.4% of the tier 1 capital for the scheduled commercial banks, and the solvency loss means that NPA's non-performing asset might increase, the asset value for the scheduled commercial bank might decrease, as well as they might have lower capital adequacy, okay, or their capital adequacy might decrease. In case of liquidity loss, the reserves might decrease for the banks. The banks will have less liquidity to provide for their depositors and such. So in case if a bank is failing that has the maximum capacity to cause the contagion, there will be solvency loss of 3.4% of total tier 1 capital. That means capital adequacy will reduce, or capital with the banks will reduce to certain extent of 3.4% of the total tier 1 capital of the scheduled commercial bank, and liquidity loss will happen of 0.3% of total high quality liquid assets that the banks are maintaining. So this is the case. Here, if the bank 1 is failing, solvency loss to the banking system will be 3.4%. and the liquidity loss to the banking system will be 0.3% of the high quality liquid asset. In case there is NBFC that is failing, so if the NBFC is failing with the maximum contagion impact, or the NBFC is failing that has the maximum capacity to cause contagion loss, so then the solvency loss as percentage of tier 1 capital to the banking system will be 2.9%, and the number of banks defaulting will be 0. Okay, if the housing finance company is failing, so if the first housing finance company is failing with the maximum impact, it will cause a solvency loss of 3.7% of the tier 1 capital. That means if the housing finance company fails, that will cause a higher impact on the solvency losses of the banking system. Okay, so this is the idea. Now coming to the chapter 3, any confusion in chapter 2? So coming to chapter 3, so we have to finish this chapter that is regarding the regulatory initiatives in the financial sector. Okay, so basically in response to growing economic uncertainty and structural shifts that are coming in the global financial landscape with the higher usage of digital systems and the fintech innovations that are coming up, okay, as well as there is climate change risk that are arising, the finance requirement for the climate change is like there is more requirement for the financing for the climate change and such. So with the structural shifts in the global financial landscape, with the cyber security threat also, okay, so with the cyber security threat as well as with the increase in digital ecosystem, with the increase in fintech innovations, with the climate change effect and the cyber security effect, the structural shifts are coming in the global financial landscape. So the regulators remain committed to enhance the resilience of the global financial system. So they are taking various steps for the rapid technological changes rising. They are taking various steps to make the financial system more resilient, to handle the rapid technological changes, rising cyber threats and escalating climate related risk. Okay, so basically there are various structural shifts that are coming in the global financial landscape, with the digital ecosystem coming up, with the fintech innovations, with the cyber security threats, with the climate change risk. So the regulators at the global level are taking various steps to mitigate the threat to the financial system. This is the basic idea. Okay, now the global initiatives I have not brought. I have brought the domestic regulatory initiatives, because this is what you have to focus more on. You can read the global regulatory initiatives also, but the domestic one you have to focus more on. Now, I'm not going to discuss all of these domestic regulatory initiatives with you, because I have taken the session on these. We have discussed the project finance directions, we have discussed the digital lending directions, we have discussed the forward contracts in government securities, we have discussed the introduction of specialized investment funds in the revision session for your finance current affairs. We have discussed the introduction of the specialized investment fund, which has the minimum limit of how much? Can you tell me if you remember? Minimum limit of 10 lakh, right? So we have discussed the specialized investment fund. We have discussed the access to negotiated dealing system, order matching. That means the brokers, the stock brokers that are SEBI registered brokers, they will get access to NDS OM for their customers, for their constituents. Okay. Prevention of financial and digital payment fraud. So to prevent the financial and digital payment fraud, the Reserve Bank of India has introduced the bank.in. This handle has been introduced, or this exclusive internet domain has been introduced by the Reserve Bank of India. The SEBI has introduced the numbers like 1600XX numbering series has been introduced, 1400XX numbering series has been used. Additionally, the SEBI has advised the regulated or the registered entities with the SEBI to use 1600 phone number series exclusively for the service and transactional voice calls, so that the frauds can be reduced and these numbers can be treated as the authentic numbers, and the other numbers will become like these numbers will be treated as the authentic numbers, and the rest the public will be aware that okay, if the call is coming from some other number, so that means this is not registered entity of the SEBI. Okay, so this is the idea. Amendments to liquidity coverage ratio framework, this we have discussed. This is very important. The liquidity coverage ratio amendment, this we have discussed in the finance 360-degree session, and the safer participation of retail investors in algorithm trading. So these kind of small topics you can read through the FSR only. Okay, so this is the idea. Any confusion? So now deposit insurance. Okay, coming to the next point, that is the DICGC insures the deposits in the banks. Okay, so the number of banks registered with the DICGC was 1,982 at the end of March 31st, 2025, and with the present deposit insurance limit of 5 lakh. So the present deposit insurance limit is 5 lakh. 97.6% of the total number of deposit accounts were fully insured, and 41.5% of the total value of the deposits were insured. Okay, so 97.6% of the accounts are insured with the banks, and 41.5% of total value of deposits are insured with the banks. Deposit insurance premiums received by the DICGC grew by 12.1%, and the highest is from the commercial banks. Okay, the corporate insolvency and resolution process. So since the provisions relating to the corporate solvency resolution process came into force in December 2016, so this process, corporate insolvency resolution process, came into being or came into force in December 2016. A total of 8,308 cases have been initiated, or the resolution process have been initiated, out of which 76.8% of the total have been closed under this process. Okay, so now coming to the systemic risk survey. So the third chapter is completed. Now coming to the systemic risk survey. So this is the 28th round of the Reserve Bank systemic risk survey. This was conducted in May 2025 to gauge the perceptions of the experts. Okay, so there were 50 respondents, from which there were 50 respondents that were the economists, as well as the experts from whom the survey has been filled, okay, or who has filled the surveys. And in this particular systemic risk survey, there were additional questions that were also asked, that was regarding the impact of trade tension and protectionist policies on overall financial stability of India, effect of trade slowdown on banking sector and the major sectors affected by global trade disruptions. Okay, so basically the systemic risk survey, this is the survey that is conducted, and the respondents are majorly the economists or the experts or the market participants. So these are the respondents. So from 50 respondents, the survey was conducted with the 50 respondents that have replied to the survey. Okay, now according to the 50 respondents, all the major risk groups. So these are the risk group: global risk on the Indian economy, macroeconomic risk in the Indian economy, financial market risk, and the institutional risk. Now you can see that all these risks are in the medium risk category. Okay, so systemic risk survey, major risk groups are these 4 risk group, and in these 4 risk group there is the medium risk as per the survey. Okay, as per the survey there is the medium risk in these 4 risk groups, but the risk has increased in the global risk category and the institutional risk category. There is the increase in the risk in these 2 categories. Okay, but still the risk in the 4 categories is under the medium. So all the major risk groups, that are the 4 major risk groups, were perceived to be in the medium risk category. Okay, now coming to the points or the indicators of these global risk. So in the global risk, you can see that the global risk has risen majorly because of the global growth that is decreasing, as well as there is geopolitical conflict or geoeconomic fragmentation. So the global risk has increased, right? It is, global risk is under the medium risk category, but still the global risk has increased. This is because of the geopolitical fragmentation or geoeconomic fragmentation and geopolitical conflict, and the global growth forecasts that have been reduced by the major entities. Next is macroeconomic risk. So in India, we can see that the macroeconomic risk has decreased. Can anyone tell me that why this macroeconomic risk has decreased? Why the macroeconomic risk has decreased in India? Because the inflation is decreasing in India. There is decrease in inflation in India, right? So here you can see that the macroeconomic risk has decreased a lot because of the decrease in the domestic inflation expectation. You can see that the domestic inflation expectation has come to the low risk category, okay? So because the inflation expectation has come to the low risk category, or the domestic inflation has come to the low risk category, that's why the macroeconomic risk has decreased. Okay, but still there is macroeconomic risk in the, like you can see, climate risk. Macroeconomic risk is arising from the climate risk, as well as there is huge risk in the capital inflows or outflows, because there is a lot of volatility that is happening in the capital inflow and outflow. So because of these 2 categories, the macroeconomic risk is still in the medium risk category, but you can understand that the macroeconomic risk has reduced because of the reduction in the domestic inflation. Okay, next is the financial market risk. This is arising because of the equity price volatility, or the share prices are very volatile, due to which there is financial market risk. There is institutional risk because of the cyber risk. Because of cyber security risk, there is institutional risk. Okay, so these are the important points that you need to keep in mind from the systemic risk survey point of view. Okay, so now risk to financial stability. So going forward, the respondents identified the following risks to financial stability. There is geopolitical conflict that is increasing capital outflow and inflow. There is a lot of volatility in the capital outflows and impact on the Indian rupee, increase in trade tariffs and impact on global trade, global growth concerns. The major institutions have reduced the global growth rates. The climate risk, cyber security issues are rising. Slowdown in domestic growth can also happen because of the external factors, and rise in US Treasury bond yield. Because if the yield or returns are increasing in the US bonds, that means the foreign investors will want to invest in the US bonds. So they will take out their investment from India to invest in US. Okay, so that will create outflows from our country. So this is it. Any confusion anyone has? So now there are a few more points. First of all, when we discussed about the FDI, so in this we have discussed, or just one point. So see, the FDI, we have seen that the FDI has decreased a lot, right? The net FDI, we can say, the net FDI has decreased from $10 billion to $1 billion. So there is a huge decrease that has come in the net FDI inflows. Now here what is happening, that actually it is said that India is still the attractive investment position, or India is still having the like FDI, India is still having the FDI inflows, and India is still attractive investment destination for the foreign direct investment. But what is happening, that when we calculate the net FDI, we see the FDI inflow and the FDI outflow. FDI outflow means that how much the foreign direct investment is done by the Indian investors in the other countries. So that is FDI outflow. So let's say FDI inflow, that is how much FDI has come to our countries from the investors, from the foreign investors. Now foreign investors, they have done a lot of investment in India, but at the same time there are some earlier investors that have taken out their money from India. Okay, so here India is still a very attractive investment destination for the FDI, but Indian investors have done more of the FDI outflow, as well as there are earlier FDI investments that happened in India, so they are also repatriating their money. That's why the net FDI was lower. So remember that the FDI inflow was quite high because India is still an attractive investment destination for the foreign investors. For the foreign direct investment, India is still an attractive investment destination. But because of the high repatriation, that means because of the high outflow that happened because of the earlier foreign direct investment being taken out from India, because of the high repatriation or the money being taken out from the investors, as well as because of the high foreign direct investment that is done by the Indian investors in the other countries, the net FDI has decreased. Okay, so the decrease in net FDI, this is basically because of the high repatriation by the foreign investors. Okay, they have taken out their money from the earlier foreign direct investment that they have done. They have taken out their money, as well as there is high foreign direct investment that the Indian investors have done in the other countries. Due to this, there was high outflow that happened, while we received the foreign direct investment. India remained the attractive destination for investment. We received a lot of foreign direct investment, but because there was a lot of repatriation and a lot of investment by the Indian investors, that's why the net FDI, that is the money that we have received and the money that has gone out, so the net FDI was lower. Okay, so this is the key point that I wanted to discuss with you additionally, because the reasons can be asked or you can use these reasons. So the FDI has decreased, the net FDI has decreased, because of the high outflows that happened, okay, from the Indian investors and the high repatriation that happened from the foreign investors, even though India remained the attractive destination for investment. Okay, so this is the idea. Now I'm thinking of taking the MCQ session next week. So for the annual report, I'm thinking of taking the MCQ session after the notification is out, but for the financial stability report, I am thinking of taking the MCQ session next week on Saturday. So should I do so, or should I take the FSR MCQ session after notification only? So for the annual report, I am thinking of taking the MCQ session after the notification, but for the financial stability report, I am thinking of taking the MCQ session next week on Saturday. So do tell me that you want the FSR MCQ session right now, next Saturday only, or next week, or do you want me to take the FSR MCQ session after the notification? Whichever, like, do comment down below, whichever you think is good for you, I will do that. Okay, so for the annual report, the MCQ session will be after notification, after the notification for your exam is out. But for the FSR, do tell me that you want the MCQ session next week or after notification. Whatever you decide, I will do that. Okay. So thank you everyone. Thank you for joining. I hope you like the session. Again, this is a very lengthy session and I was feeling like not very good today, but I thought to not delay the session, because you have to revise also, you have to reread the document, or you have to rewatch the session many a time. So I do not want to delay it. So I've taken it today, but I hope you were able to understand everything very well. I will take a MCQ session next week or after the notification, whatever you people decide. Okay. So thank you everyone. Thank you for joining. So thank you everyone. Thank you for joining, and see you in the next session on Saturday. Okay. Thank you everyone.